Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be explaining exactly what market indexes are and also why they are one of the best investment vehicles when it comes to the stock market. And if that sounds interesting to you, then please do me a favor and give this video a like and subscribe to my YouTube channel. It would really help me out a lot. And so, as always, before getting started here, if you are interested in taking a deep dive into options trading, and stock market investing, please check out my Skillshare courses. I've been teaching on Skillshare for over a year at this point. Skillshare is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data, spreadsheets, graphs, and computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership on the Skillshare platform to watch my courses, but if you do sign up for that kind of membership with the links provided in the description of this video, you will get an absolutely free 2-week trial. And during that time, you can watch all my courses on Skillshare for free. And then once your trial has ended, it's only going to cost you a few dollars a month to maintain that membership, and you'll gain access to all the future courses that I have planned going forward. And if you decide it's not for you, no worries, you can cancel your membership before your trial has ended and you won't lose a dime. But Skillshare really is a super affordable way to learn something new, and you'll get a ton of value out of it. So again, if you are interested, please check out those links and join the thousands of other students that have already taken my classes. And so now diving in here and talking first about what exactly is a market index. A market index is simply a measurement tool of sorts that represents the current performance or a value of a specific segment of financial markets or of the entire financial market as a whole. And so the way these market indexes are constructed is you would simply take a basket or a collection of stocks within a specific sector or industry, or multiple depending on the index, and you would aggregate their prices together in such a way to give you one single number. And this number is the thing that represents the current performance or the value of that specific industry or that collection of industries. Now, depending on the actual index, there will be differences in how this aggregation process is actually carried out. And specifically, I'm referring to the way the stock prices in these indexes, in these baskets, are weighted. Some indexes will weight the prices of the stocks within that index based on things like the market capitalization of those companies. Other indexes might use the company revenue or other forms of fundamentals about those companies, and so on and so forth. And by these index price weightings, I'm simply referring to the effect that each of the individual stocks within the index has on the total value of that index. So for example, if you were looking at an index that weighted the individual stocks within it based on their market capitalization, then a company like Apple, with a market cap of over $2 trillion at this point, would have a much greater effect on that index than much smaller companies. And so like I said earlier in this video, you could have indexes that track specific sectors or industries, like just the tech industry, or just financials or industrials. Or you can have indexes that track multiple sectors and industries, the most important of which would track all of them together. And the indexes that track all sectors and industries together, or at least the vast majority of them, is where you'll find things like the S&P 500, the Dow Jones, the Nasdaq, and the Russell 2000. And so perhaps you've heard of one or more of those. And so even though, yes, market indexes are a great tool for giving you an idea of how the collective performance or value of a certain basket of companies is doing at the moment, but they're also great investment vehicles. And so now we're going to hop over to my trading platform and I'll show you why. All right, welcome to my trading platform here, and showing you first, this is the S&P 500 index. You can see it right here. And if you wanted to pull this up yourself on your own trading platform, you can just type in the symbol SPX and that will bring this up here. And so the S&P 500 index tracks the 500 top companies in the United States across all sectors and industries. And what you're seeing here is simply a price action chart that shows you how the value of this S&P 500 index fluctuated across time. So on the x-axis here, you can see all the different years, 2015, 2014, 2013, going all the way back to 1997. So this is a good 23 years worth of data. And then on the y-axis here, this shows you the value of the S&P 500 at a certain point in time. So for example, we can go to the end of 2014 and go up to the graph right here, and then go over to the y-axis, and you can see at the end of 2014, the S&P 500 was right around 2,000, right? So like I said earlier in this video, this number here is simply the result of aggregating the prices of the 500 companies in this index together, which in the case of the S&P 500 is based on the weighting of the company's market capitalization. And so this is probably the most commonly used market index. I, for example, certainly look at this index the majority of the time to get a gauge on how well the market is performing. But there are also 3 other indexes that I personally use as well, and that the vast majority of other investors and traders use too. So for example, I can go back over here and type in NDX, and this will show you the Nasdaq 100 index. So same basic idea here, 23 years worth of data, and on the right hand side, this is where you can see the actual value of the Nasdaq index at any point in time, and it functions in basically the same way as the S&P 500, although in the case of the Nasdaq 100, as I'm sure you could tell by the name, the basket of stocks it uses is only 100 companies as opposed to 500, and the Nasdaq index is a lot more heavily weighted towards the technology industry. There are other companies in different industries that do get factored into this index, but the biggest components of this index are companies like Apple, Amazon, Google, Microsoft, etc., other big tech companies, and so those corporations in particular do have the largest impact on the value of this index. And so for this reason, I typically use the S&P 500 to get a gauge on the entire stock market as a whole, and then I will look at the Nasdaq here to get a better idea of how the technology space is performing. There are other indexes that focus exclusively just only on tech stocks. Like I said, this Nasdaq here does include other companies too, but still using the Nasdaq does give you a pretty good proxy or estimate into how technology stocks are performing. And you can see quite clearly here, ever since 2008, they have performed exceptionally well, right? For these kinds of indexes, the higher the number, the better, because this means that the performance and value of these companies within this index is getting better and better and better over time. Now, one of the oldest indexes that is still in use today is the Dow Jones Composite. So you can go over here and type in DJX, and this shows you, of course, the Dow Jones Index. And I personally don't use this one a whole lot. It's only comprised of 30 companies as opposed to 500 for the S&P or 100 for the Nasdaq 100. The Dow will still give you a very good estimate on how the entire marketplace as a whole is doing. But for me personally, I believe you get a better view or a better gauge on how the stock market is doing when you are factoring in a lot more companies. But still definitely wanted to show you this here because it is still in wide use today. And the last one I'll show you here is RUT. Press enter, and this is the Russell 2000 index. And once again, based on the name here, I'm sure you could assume that this index includes a basket or a collection of 2,000 individual companies. And so like the S&P 500, the Russell 2000 will give you a pretty good gauge or estimate on how the entire marketplace is doing, but the Russell 2000 does include a lot of smaller cap companies. And smaller cap companies simply meaning these companies are a lot smaller than your giant corporations like Apple, Google, Amazon, and Microsoft. And so I definitely also like to use this index to give me some insight into how a lot of the other smaller players are doing compared to the big names that most people already focus on anyway. And that's because when things start to go south in the market, it's usually the smaller cap companies that start to show signs of trouble first. And so keeping an eye on what the Russell is doing, in addition to the S&P and the Nasdaq, I think is very, very beneficial. Now, one thing I want to point out here is the actual values of these indexes themselves. You can see right now the value for the Russell 2000 is just under 2,200. But if I go back to the S&P 500, for example, you can see the value for this index right now is 3,700. And then if I go to the Nasdaq, you'll see it's almost 13,000. So depending on which index you're looking, the numbers you see are going to be very, very different. And so this is why the numbers themselves don't mean a whole lot. Rather, it's the percentage change of these indexes on either a day-to-day basis or month-to-month, year-to-year, that really matters. So when the Nasdaq, for example, drops by 300 points, that might seem like a lot, but because this index is almost 13,000, that's only going to amount to about a 2% decline. But a 300-point drop for the S&P 500, that would be around 10%, way, way different. So like I said, you always want to be comparing the percentage changes of these indexes and not care too much about the actual point swings themselves. So when the Nasdaq drops by 2%, okay, then what is the S&P 500 doing? Maybe that index only fell by 1%, or maybe the Russell 2000 actually increased by 0.5%. And so it's those percentage differences that are going to allow you to paint a much fuller picture of what is going on in the full market. And so now getting into the final point of this video, why are these indexes great investment vehicles? And perhaps based on what you've been seeing so far here, you might have been able to already guess. And the answer is because over a long period of time, right, 23 years for example, all of these indexes have all done one thing. They have gone up. Yes, of course there are periods of time where the indexes do go up and then come crashing down, right? This here was the dot-com crash, which definitely affected the Nasdaq a lot more because the dot-com crash was mostly tech stocks. And the Nasdaq, as I said, is a mostly tech-dominated index. But even after a massive, massive decline like this, right, going from almost 5,000 down to about 800, that's like an 85% decline. Well, fast forward in time, many years later, and the market did recover, and it did surpass the highest point from back in 2000. And then it continued on after that. So even when the market goes down, when it crashes, when it takes a small dip, when it goes just sideways for a while, the long-term trajectory of all of these markets is still up. And I can zoom in here actually, and you can see right here, back in last February and March, this is when the coronavirus pandemic scared everybody, and the market crashed by over 30%. And this was one of the fastest and most severe market crashes we've ever seen in history. And then look what happened after that. Not only did the market recover its losses in only a few months, but it surpassed its old peak by many leaps and bounds after that. And so this means if you are investing for the very long term, right, it's important to understand investing in these indexes is a long-term strategy. And so if that is your intent, then rest assured over the long term, these markets will continue to rise. And sometimes it can definitely be difficult to remember that, of course, especially during times when the market is actually going down and going down significantly. But so far at least, every single time the market has gone down, every single time, the market has always recovered and it has always gone higher after that. Now, of course, there is no way to predict the future, but I do truly believe that as long as the world keeps spinning, as long as these companies are allowed to continue to expand their market share, to increase their revenue, to produce more products, to gain more customers, etc., that the value of these markets and the value of these indexes will continue to rise. And so that means if you put your money into an asset that tracks these indexes, because there actually is no way to literally put your money or invest into the Nasdaq 100 index or the S&P 500 index, you have to instead put your money into a fund or some other asset that tracks these indexes. And there are many, many hundreds and thousands of different funds and ETFs and other forms of investment vehicles that will do just this. And I'll make more videos in the future explaining how exactly that stuff works. But for example, if you wanted to invest in the Nasdaq 100, in that case, you can simply just buy shares of QQQ. Press enter here. And so this is a graph of the ETF QQQ that simply tracks the Nasdaq index. And you can see the chart looks pretty much exactly the same. The pricing is obviously different. You can see these individual shares are trading right now for $314, not $13,000. And that $13,000 isn't really even a number in terms of dollars or currency, it's just a number. This rather is the actual share price of QQQ. But you can literally buy these shares of this ETF, and again I'll make more videos explaining what ETFs are and index funds and all that stuff later. But you can buy shares of this investment vehicle that will track exactly the Nasdaq index. So even though you are not literally investing your money in the Nasdaq index, you are doing the very next best thing. And so far at least, this would have been a very, very solid investment, especially if you had bought in back in 2001 when the market had pretty much bottomed. You can see at this time these shares were trading for only about $20 per share. So if you bought one share of QQQ at a price of $20 per share and you held it all the way until today, that share is now worth $315 almost, which I believe is something like a 1,500% return. So I hope this gave you some good insight into how all this stuff works, and hopefully also gave you some good ideas into how you want to start investing your money.
Alright, so that concludes this video. I hope you enjoyed it. And again, if you are interested in taking some in-depth classes on options trading, and stock market investing, please check out my Skillshare courses. Links in the description of this video. And lastly, if you enjoyed this video, please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.